cash flow or capital growth. For as long as I can remember, this has been a highly contested topic. So let's have a look at what it can mean to us as investors. Okay, so first of all, what is capital growth? So capital growth can be defined as the profit made on an investment property purchase based on its original purchase price and its current market value. So the difference between what it's worth now and what you pay for it effectively. Now, cash flow, I just want to point this out quickly as well, that when we're talking about cash flow, we're not talking about yield. So yield is effectively just worked out as the annual income, rental income divided by the value of the property. So what we want to be careful with there is that you can have two properties that have the same annual income and the same value, but their cash flow position can be totally different. So when I'm speaking about cash flow, I'm looking at the actual net cash flow position of the property after considering all the income and all the expenses for that particular property. Now, when I first got really serious about property investment, at the time there was some really strong opinions on both cash flow and capital growth around the strategy and what you should be adopting. In fact, there was a couple of people who basically were stating that if you don't buy positive cash flow property, so property that actually puts money in your pocket from day one, then you're effectively doing the wrong thing. And counter to that was that if you are buying property that is purely based on cash flow and not all about capital growth, then again, you're doing the wrong thing. So for us as investors, it can become a little bit confusing, particularly when you look at sometimes why these comments are being made. You know, is there an agenda? Is there a reason behind making the comments? Is it what they're selling, what they're promoting, what their material and content is about, etc., etc.? So to be able to then work through all that information and then decide, well, what is actually fact and what is, again, presented based on an agenda, then it can be, again, a little bit difficult to work through. So what I want to do now is just come through and we'll look at the facts, and then we can decide really what it means to us as an investors, because what the numbers need to look like or what the strategy is for me versus you could be totally different, and the next person down the road as well. So we want to make sure that we're working to our own rules and we understand what it means to us as far as what cash flow and what capital growth can then deliver to us as investors. Okay, so now the theory was that basically if you wanted positive cash flow properties or high cash flowing properties, then you effectively had to go to mining towns, and if you did that, then it was very highly chance that you weren't going to get any capital growth. So great cash flowing properties, however, capital growth would be pretty much non-existent. Then the other argument was, well, if you're going to acquire high appreciating property or high capital growth potential properties, then you need to go to the middle of capital cities, and it's going to cost you an arm and leg to hold on to that property because the outgoing costs are going to be far in excess of any income that you're going to receive. So for me, and from working with people who are successful investors, the truth lies somewhere in between those two things. So we also want to remember too that a high cash flowing property, and particularly in these conditions where we're paying very low amount for our money, so the interest rates are very, very low, it's a lot easier to find higher cash flowing properties. They're not everywhere, but it's a lot easier to find them than it is, say, when interest rates are up at around 7, 8, 9%, because we have to keep in mind that and be very aware of the fact that the cash flow position of property, the main factor that changes that cash flow position of a property are interest rates. So again, if the interest rates are very low, then it's easier to find higher cash flowing properties. But what we've got to remember is that if interest rates go up, that's going to change that cash flow position, and it could be considerable. So if you find a property you think this is great, great cash flowing property, it works for me, you want to do some calculations around, well, what will that look like if interest rates go up? And there's a saying, and I really like it, says that everyone looks good naked when the tide's in. When the tide goes out, you want to be left exposed. So you need to understand what it looks like to you when these factors shift within how we determine and how we factor and how we consider and determine the net cash flow position of a property. So this is something that I work to and really basically sits well with me as far as what it looks like overall. And so it revolves around the fact that cash flow allows me to sustain my portfolio, and the capital growth will create the returns and also the exit options or exit strategies. So you're not going to make money on properties that have a typical yield of 5 or 6%. It's just with all the outgoing costs, etc. It's just not going to allow you to have an income that you'll be able to retire and live off, unfortunately. So unless you've got a way around that, I'd love to hear about it. But ultimately, at the end of the day, just typical standard yielding properties aren't going to deliver enough income for you to use that income to live off or replace your working income. So it's about the capital growth. So we need to then make sure that we understand what that looks like to us. And it will, again, I know I've mentioned this before, but this is where we don't want to be pigeonholed. It's going to mean different things to different people. So the other thing is that we can really look at is, well, why does it have to be one or the other? And effectively, you can have both, and both are required. So there's no reason why you can't have a portfolio that contains cash flowing properties and high capital growth potential properties either. So that's a myth too, to say that you need to have one or the other. So we're also going to need to understand that the capital gain allows us to also leverage into other properties. So if we're looking to build a portfolio of multiple properties, then we're going to need capital to then be able to use that to then leverage into additional property. Now, with higher cash flowing properties, if we use that cash flow smartly, what we can do then is direct that surplus cash flow or surplus cash back into our debt to reduce debt. So if we get a capital gain in our property, but at the same time we're paying debt down, then we're going to increase that equity that we have available to then leverage into additional property. So that's another way of looking at it as well. So again, that balance of properties in your portfolio can help with debt reduction as well if you've got positive cash flow or high yielding property within your portfolio. So that can be debt against your own home as well. So remember, we can gain equity and leverage from equity in our the principal place of residence to then leverage into investment property as well. All right, so the bottom line really is that you're going to need both, and what that looks like and what degree, I guess, of both will come down to you effectively. It'll come down to things like what's your investment time frame, what's your financial position as far as your personal cash flow position, and also it'll come down to the available equity or capital you have available at any given time. So it's about you looking at your current reality, looking what your desired outcomes are, and then trying to close the gap. And what do you need? How much time have you got to close that gap? And what do you have available to you? What do you look like as a business? And you personally around your risk profile, etc. Those things play a big part in it as well, particularly your risk profile. If you've got a short amount of time to invest in, but you don't want to go out and buy multiple properties quickly, you may need to look at, well, then what else do I have available to me? Superannuation, maybe I've got a business that I can sell, cash savings, etc. So it's important to understand that if you have, depending on your time frame, investment time frame, you really need to factor in your risk profile as well to make sure that you're staying true to your rules. That's very important. Otherwise, you could be doing things that don't feel comfortable with you and don't work to what you are happy to take on as far as risk, because the last thing you want to be doing is stressing every day about what it looks like to you. So it's important that we consider the numbers, but also ourselves as investors stay true to our rules and also invest within our means. Okay, so cash flow is the lifeblood of your portfolio, and the capital growth creates your long-term wealth. So let's just have a look at this example, and I think this will show what I'm talking about as far as having that cash flow position such that you can sustain a portfolio. So let's assume that we owned 4 properties: Melbourne, Brisbane, Perth and Sydney, and we acquired them before 2016. So Unfortunately, though, we acquired properties in those locations that we just couldn't afford. They were just, the cash flow position of the properties was such that it was eating into our personal cash flow position to a point that we just couldn't sustain the portfolio. So we were forced to sell those properties in 2000 or prior to 2016. So based on CoreLogic's figures, we can see then that the values of those 4 properties in 2016 and the net worth of that portfolio, the value of that portfolio was $2,255,000. Now, if the scenario was such that we had to sell those properties, then over the last 5 years, we effectively would have missed out on around about $500,000 worth of capital growth. So that's why it is important that we have a balance of both. So again, that cash flow position of those properties, had they been in a cash flow position that meant that we were able to sustain those properties, then the flip side of that would have been that we would have gained ourselves nearly $500,000 in capital growth. So again, it's that balance. It's a balance how it works with your cash flow position. The number one reason why people sell properties is because they can't afford them. So it's important that we get the numbers right, but it's also important that we work to what we feel comfortable with as well as investors. So that, I think, illustrates the importance, if you like, of being able to sustain and have that cash flow position such that we can get rewarded for being sensible about how we invest and understand the numbers and work that back to ourselves as people, because after all, it is about us, and that long-term wealth won't be realised unless we can sustain that portfolio. So just sort of run through that to illustrate that point, I guess, of that balance between cash flow and capital growth. Okay, well, I hope you found that video helpful. If you did like the video, please feel free to give it a thumbs up. And equally, if you haven't already subscribed to my channel, it'd be sensational to have you on board. I'll continue to post free content every week, and hopefully that content will allow you to think more clearly and have more confidence and clarity around how you can invest in property safely and successfully. So whatever you choose to do, I wish you all the best on your journey. Thanks so much.